The foxes in the stock market. Once upon a time, there lived 4 foxes in a large forest. One fine day, 2 of the foxes got very hungry and roamed all through the forest in search of food. But perhaps it was an unlucky day for them. After roaming in the forest for the whole day, they were still hungry. After a lot of searching, they came upon a vineyard with huge bunches of grapes. As the foxes were beginning to get weak and tired out of hunger, they started losing patience. As the grapes were attractive, without even analyzing whether the grapes were ripe enough, the impatient fox number 1 jumped high and grabbed a few unripe grapes. As the grapes were not ripe enough, the hungry and impatient fox felt the taste to be extremely sour and decided to walk away. When fox number 2 started jumping to grab the same unripe grapes, fox number 1 spread negativity and told him to quit trying as he felt that the grapes were extremely sour. Fox number 2, without even analyzing on his own if any ripened grapes were available in the vineyard, quit trying and decided to walk away with the advice of fox number 1. Next, fox number 3 began his pursuit for food in the vineyard and to his luck stumbled upon the biggest, juiciest grapes he had ever seen. They had a rich, purple color, telling the fox that they were ready to be eaten. To reach the grapes, the fox had to jump high in the air. As he jumped, he opened his mouth to catch the grapes, but he missed. He tried a few more times but kept failing. Finally, fox number 3 decided it was time to give up and go home. While he walked away, the disappointed fox consoled himself by muttering, "I'm sure the grapes were sour anyway." While all the other 3 foxes returned home with an empty stomach, fox number 4, which was patient, reached the vineyard and assessed it carefully. It also identified the same juicy and ripe bunches of grapes and tried jumping hard to reach them. The more he failed, he kept learning that there were a few spots which would not be ideal for him to jump from. So, he kept analyzing and finally identified the ideal jumping spot and made a huge leap. Viola. Fox number 4 grabbed the juiciest bunch of grapes and had a sumptuous meal. Now, let's apply the lessons we learned in this story to the stock markets. Impatient, not understanding market cycles. Like fox number 1, there are many people who enter the market just to try their luck. They buy stocks without understanding the cyclical nature of the underlying business, make no money and spread negativity. Once they lose money in stocks, they start sharing their failed experience with others and try to stop them from entering the market. So, what should people do to avoid this situation? You need to assess thoroughly the volatility and cyclical nature of stocks before proceeding. Now, what are cyclical and non-cyclical stocks? Cyclical stocks are volatile and tend to follow trends in the economy, while non-cyclical stocks outperform the market during an economic slowdown. For example, taking the current COVID-19 situation, surgical mask market is cyclical whereas pharma industry is non-cyclical. Volatility refers to price fluctuations and describes the speed and amount of price changes. In most cases, the higher the volatility, the riskier the security. For example, when the stock market rises and falls more than 1% over a short period of time, it is called a volatile market. If a stock or a market has lower volatility, it means that the chances of it experiencing any big swings are unlikely. Lack of investment knowledge. Coming back to the story, like the fox number 2, there are willing people who want to invest in the stock market but are unable to because of lack of knowledge and proper guidance. They take the advice of wrong people or failed people and never invest in the stock market. Unrealistic expectation of returns. Next, let us look at people who are like fox number 3. Amateurs come to the stock market with unrealistic expectations and often get disappointed. They are completely ignorant of the right returns they need to expect while investing. So, when they fail to get the right returns, they don't realize that nothing comes easy and hence despise what they cannot have and call the stock market sour like the fox. Then, what is a realistic expectation of the returns in stock market? Over a long term, the stock market tends to grow only as much as GDP growth plus inflation. Your long-term gains might be GDP plus inflation per year. For example, with GDP at 5% and inflation at 7%, that might be 12%. Similarly, you will only get the same kind of returns if you invest X amount of money each year into a low-cost index fund. Another lesson to learn is to not time the market. But many investors try to time the market. When they listen to someone who sounds positive about the market, they invest extra money in the market. Likewise, upon hearing a lot of dire warnings from experts, they start selling their stocks. But studies have shown that investors who try to time the market tend to significantly underperform. Do not do that. Knowledge, patience and long-term wealth creation. Finally, whom do you think will win in the stock markets like fox number 4? A patient investor who has realistic expectations, analyzes the market thoroughly and learns from his mistakes alone wins in the market. Remember, even in stock market, the slow and steady wins the race.